Hi, I want to welcome you all today to a short briefing with Katie Sulkowski, a friend of ours with Polen Capital out of Boca Raton, Florida. And Katie, I want to start off on the mission that Polen has, our mission statement. Why don't we start there?
Absolutely. So our mission at Polen Capital is to preserve and grow our clients' assets in order to protect their present and enable their future. And I really like to note the placement of the words preserve and protect, which precede grow and enable. So at the very cornerstone of who we are at Polen Capital is that protection and preservation of capital. Secondarily, we're looking to grow that capital for future generations. We've been running concentrated growth equity portfolios for 32 years and have had a very successful track record of delivering 16% annualized, but more importantly, only capturing about 58% of the downside, so about half of the risk.
Yeah, so I want to go more into the risk side because that's what really attracted me to you all. You know, we can easily find high performing outfits like yours, but it's hard to find outfits like yours that do so well in the downturn. So why don't you talk about how focus is done in like the dot-com bubble and the downturn in 2008?
Sure. So from 2000 through 2002, so during the tech bubble, cumulatively, our portfolio is down 14% over those 3 years. This is versus the growth index, which was down over 70%, and the S&P 500, which was down over 40%. So strong outperformance. And what really led to that outperformance is we have a very teachable and repeatable process that our investment team executes on. It is founded on finding high quality companies that are reinvesting for growth. We hold them over the long term and we mitigate risk in every way possible. At the very tail end of our process, we consider valuation. So what is the stock trading at in the general market? It's called the price to earnings ratio, but essentially it's the valuation. And we want to make sure that the companies we own in our portfolio are not trading at an extreme valuation that's demanding perfection of the business. A simple earnings miss or slight misguidance might cause that stock to tumble. So what kept us protected during the tech bubble was really not owning those high-flying tech names that were valued extremely high with no proven track record of profitability. Fast forward to the financial crisis in '08, the entire stock market was very impacted. Our portfolio was down 27%, and this was compared to the growth index, which was down 38, and the S&P 500, which was down 37. So strong outperformance. However, we really focus in on the earnings growth. So the stock market's very emotional and irrational day to day, month to month. But if you look at the individual companies and the top line, so the revenue growth, the earnings growth, as long as that is stable and secure, we really feel that over the long term, stock prices will catch up with the health of the underlying business and the growth of the underlying business. So even though we were down 27% in '08, the companies actually grew their earnings, continued to flush cash back into their businesses, and grew their earnings by 16%. So while the competition was facing a lot of headwinds in terms of refinancing at higher rates, our companies were flushed with cash and in a very healthy position. Fast forward now to the recent drawdown driven by the pandemic in March and April of last year. Again, we protected by over 4 percentage points versus the general S&P, and that's due to just the continuous execution of our investment process, which really focuses in on exceptionally high quality companies that have a very strong competitive moat around their business. So they can really make it through difficult times using cash on hand and actually gain momentum when the competition is kind of falling to the wayside, if you will.
Let's look at a couple of your holdings in the focus, and could you highlight a couple of the names in there?
Sure, absolutely. We really love companies that have reoccurring or subscription-based revenue. So many of you are aware of Adobe We know it as the PDF creator. But what not everyone knows about Adobe is about 70% of their business is through creating the digital ads, the digital media that we see on Google, on Facebook, on the side of our news feed. So they're actually the backdoor player to digital advertising. The other 30% of their business is digital marketing. So assisting companies with targeting the correct customers and really integrating that digital advertising and media into their business. So they are pretty much a monopoly in this area of the market. They have subscription-based revenue. They've moved away from having licenses and having to renew those licenses. Now there's long-term contracts. So the growth of the company is more or less predictable with very limited gray areas. It's been an exceptionally strong holding that we've held for many years. Another company with a very similar revenue stream is Autodesk. So it's really the gold standard in terms of the construction and engineering industry. It's the software that companies need in order to get approval of plans. In the UK, actually, you can't put up a building without using Autodesk's BIM software. Again, reoccurring subscription-based revenue. So that really allows us to look out 5 to 7 years, which is our typical holding period, and have a certain amount of predictability in terms of their revenue growth.
So our clients are able to get a hold of the focus through only a mutual fund. But a lot of our clients like to have a single managed account, and or separately managed account, I should say, SMA. So they have access through your global portfolio. Could you explain a little bit about that and the differences and similarities between the focus and the global?
Sure, absolutely. So our focus growth is our US large cap portfolio. We were researching a ton of outside US businesses in terms of the competitive landscape. So we owned Nike in our US portfolio. You have to know about Adidas. We owned Oracle. Their direct competitor is SAP out of Germany. So Nike and Adidas, Oracle and SAP, pretty much global duopolies in their respective spaces. We realized as we were studying the competition that we'd really like to own all of these companies. So we opened up our investable universe to go anywhere for the highest quality businesses. Our global growth portfolio has been around for over 6.5 years. It's delivered nearly 18% annualized and very strong downside capture. So as the track record has lengthened, we've been very pleased to see it mimic that of our 32-year strategy. And again, it's our best idea portfolio, currently 24 holdings.
And you said that's your favorite, isn't it?
It's the most steady, in my opinion. You look at the revenue and where it's coming from. These are global multinational companies that have very diversified revenue streams. So across US, developed markets, as well as emerging markets. So you look over the last 6.5 years, the portfolio has never delivered negative returns. And in difficult years, it's outperformed the relative benchmark by over 12%. So it's been a very strong, steady strategy.
Now the other one is your US small company. Can you talk about that and the team that runs that?
Sure. So for a very long time, we were delivering exceptional returns to our clients. With our our US large company portfolio, delivering 16% annualized, we're virtually doubling our clients' money on a 5-year rolling basis. We thought, what if we applied these exceptionally high guardrails, the same investment philosophy and process, to companies earlier in their life cycle? One, because they're earlier in their life cycle, they should be growing at faster rates. They're coming off of a lower base. And two, if you look at the 2,000 small companies in the US that are in the market or the benchmark, about 43% of them are not profitable or not generating free cash flow. So if you just removed those companies, you'd already be in a better place, much less if you hand selected the 25 to 30 highest quality companies. We really felt that we could deliver exceptional returns as we have in the US large cap space. In doing so, we brought on Tucker Walsh, who was a former portfolio manager in the space with a company called Copper Rock. He had a 5-year track record of running a concentrated portfolio with great success and a very aligned philosophy, high quality, concentrated, long holding periods. So philosophically, we fit very well. He rolled out the strategy 4.5 years ago and has delivered 26% annualized. So doubling clients' money on a rolling 3-year basis.
So do you mind mentioning a couple names of stocks that you have in your small company portfolio?
Sure. We've seen the pandemic really democratize the playing field for small cap companies. So where you used to need a ton of cash to start a business, these digitally enhanced companies really don't need all that much initial cash outlay. All they need is a strong workforce, a strong connection with the end consumer, and that digital capability. So we've seen incredible success with companies like Etsy. So you have Amazon really as the market leader in e-commerce and marketplaces online, but they're not going after the niche markets like artisan and unique crafts, which is what Etsy provides, a merchant to buyer experience in that specific sector. They have a very close connection with the end customer, so they can iterate and update their product offering in accordance with what the consumer is demanding. Similarly, one of our most recent holdings is Trupanion. So in our large cap portfolio, we own a company called Zoetis, which is animal health. It's spun out of Pfizer in 2012 and is unique that it's one of the only companies that specializes in just animal health. It's not a segment of human health. In our small cap portfolio, we own Trupanion, which specializes in pet insurance. So the digital connection from the insurer to the pet owner and the veterinarian. It really expedites the reimbursement of claims and facilitates quicker resolve. So these digital capabilities and solutions, we feel, have really presented a strong opportunity in the small cap space.
Well, I want to thank you, Katie, for joining us today and helping us understand who Polen is and how they manage money. And for our clients and prospects, if you have any questions and you'd like to learn more about Polen, please give us a call and we'd be glad to answer any of your questions. Thanks a lot.